Thank you for joining us for this edition of the JIC Research Edge. This video was actually filmed earlier this year, but the principles of our asset allocation discipline are timeless. Toward the end, we've also updated the commentary with implications of the current COVID-19 crisis on portfolio asset allocation. Please watch the video in its entirety to learn about our views on asset allocation and how we are positioning client portfolios in the current environment.
Hello everyone, my name is Fred Brink. I'm the Managing Director of Johnson Asset Management and Senior Portfolio Manager, and this is the JIC Research Edge. I'm joined today by Jason Jackman, President, Chief Investment Officer here at Johnson. Jason spends a substantial amount of his time working on asset allocation through his leadership of our portfolio strategy team. Today, we're going to introduce to you our approach to asset allocation here at Johnson. Jason, thanks for being here today.
Absolutely.
Before we talk about the process and approach, it might be helpful if you just remind people what asset allocation is and the role it has in portfolio construction.
Historically, asset allocation is the most important determinant of return and volatility in portfolios. So what we're ultimately trying to do is create the optimal mix of both on behalf of our clients. Research suggests historically by combining various asset classes together, you can often enhance return or reduce volatility due to these diversification benefits. Let's consider a very simple example of just stocks and bonds. If you look at this chart, it shows various portfolio combinations of stocks and bonds going all the way back to 1926. The vertical axis is total return, horizontal is standard deviation, a measure of risk. We've circled here a 100% bond portfolio and what the 10-year rolling time period average annual return is compared to its standard deviation. That next dot above it and to the left is adding 5% in stocks to that bond portfolio. So 5% stocks, 95% bonds, you've actually enhanced the return and reduced the risk because of the diversification benefit of these two asset classes working together. That works all the way up to about a 50-50 portfolio where then at 50% mix, you're actually increasing both the return and the risk as time goes on. So this chart demonstrates a very simplistic definition of diversification benefits of just stocks and bonds. We can further add to that by adding real assets, alternatives to the mix, and provide even a better risk-return framework for clients going forward.
So asset allocation is important.
Absolutely.
With that in mind and all the things you just discussed, how does JIC go about determining the optimal level of asset allocation for our clients' portfolios?
We start by getting to know our clients, their goals, their objectives, their time horizon, their spending needs, their risk tolerance. We meld all that together with our best research ideas to create customized portfolios that are both highly diversified and quality oriented. Client portfolios can look quite different when you think about various client situations. Think about a retiree that might be drawing on their portfolio to meet their spending needs once they've retired. Compare that to a young accumulator of assets that has a very long time horizon. Those portfolios can look very different. So we spend a great deal of time determining the appropriate mix of assets for client portfolios and dedicate a meaningful amount of resources to that effort. On the equity side, the individual equity research process combined with the equity strategy team help shape our equity outlook for portfolios, and that can weigh in on things like the mix of large to small stocks or the domestic versus international mix. On the fixed income side, that team focuses heavily on investment grade bonds in the individual security space, but also outside managers for alternatives or high yield bonds. All that research from the various teams flows up to the portfolio strategy team that makes the ultimate decision on asset allocation.
So the process is very team-oriented.
Absolutely.
So what may cause that team to make a change in the overall asset allocation?
Asset allocation at its forefront is very strategic and long-term in nature and very dependent on client objectives and goals. So the team starts by building out this long-term strategic asset allocation ranges that they believe are suitable through the entire economic cycle. We then set tactical weights within those ranges based on our assessment of the fundamental valuation and risk management outlook for the asset classes. Now, you wouldn't expect this mix to change much for a typical client unless their situation changes meaningfully, because it's difficult to time the market. But investors are people, and people are emotional, and oftentimes investor sentiment and emotion can drive the market too far in one direction, creating opportunities for us to optimize that portfolio mix. For instance, oftentimes an asset class can be overlooked by the market and become relatively cheap. We can find a pretty optimal entry point into that asset class that even though its fundamental backdrop might not be as strong as other areas, it can provide good prospective returns because of that cheaper valuation entry point. Alternatively, our fundamental assessment of an asset class might be above that of the market or other alternatives, and so we can have a fundamental baseline for an asset class performing well. And finally, risk management is a key part of our discipline. We want to ensure our client portfolios are protected on the downside and also against unexpected risk factors. Think about things like unexpected increases in inflation or interest rates or other economic issues that may surface.
Sounds like a very disciplined process.
Absolutely.
Can you maybe cite some historical examples of where that disciplined process would have led to changes in the overall asset allocation?
The current COVID-19 crisis is a perfect example of one of these unexpected risk factors. While client asset allocations are positioned to withstand unanticipated shocks like this pandemic, we were positioned even more conservatively heading into 2020. We felt that the stock market was underappreciating economic risks and that valuations were stretched. We also had more cash in client portfolios as further buffer due to the uncertain economic fallout from the policy response and consumer behavior changes related to the virus. The unprecedented simultaneous shutdown in many of the world's largest economies have had severe economic consequences. And during the depths of the market decline in mid to late March, selling was somewhat indiscriminate. Asset classes and individual stocks with better fundamental outlooks within the recession and coming out were down just as much as those with less favorable fundamental outlooks. We were able to swap into some of these asset classes and individual companies to position the portfolio even more favorably for what's on the other side of all this. One of the truly unique aspects of this market sell-off and recovery, though there have been many, such as the speed of the decline and the magnitude and speed of the bounce off the March 23rd lows, is the narrowness of the stock market right now. Not since the late 90s have we seen the market this narrowly focused on expensive mega-cap growth companies. The top 5 companies in the index, Amazon, Apple, Microsoft, Google, and Facebook, make up over 20% of the S&P 500. While the index is barely down for the year, the median stock is down over 10%. At some point, through medical advances to combat COVID-19 and building expectations for a broadening self-sustaining economic recovery, smaller stocks and those with lower valuations will benefit. Incrementally, we have begun and will continue to invest in companies and asset classes that will benefit from this broadening out of the market. This is one of the long-term opportunities we are seeing amid the current market volatility. All of these asset allocation shifts are done on the margin and do not lead to extreme positioning in client portfolios. Long-term success is achieved through investing in a diversified portfolio of quality securities and adhering to a disciplined approach to asset allocation.
Great, Jason. Thanks. That was a wonderful overview. And thanks to all of you watching at home. Remember, as always, if you have any questions, please feel free to reach out to your team at Johnson.